Welcome to the Deep Dive. We're your line into what really matters from corporate earnings calls.
And today we're digging into Home Depot. They just released their second quarter fiscal 2025 results back on August 19th.
Yeah, and like we always do, we're going to break down what happened, figure out why it's important, and maybe see what clues the company gave about what's next.
All straight from what they said on the call.
So, Home Depot. Are we talking about, a big surge in people fixing up their houses, or is there maybe something more strategic going on under the hood?
It's a good question, and the top line numbers give us a place to start. So for Q2, their GAAP earnings per share, that's the standard accounting measure.
Okay.
It was $4.58.
Okay, and adjusted.
Yeah.
Because companies usually provide that too.
Right, the adjusted EPS, which kind of smooths things out, that landed at $4.68.
$4.68. How did that stack up against what Wall Street was expecting?
Both were actually a little bit below the consensus estimates. Analysts were looking for something maybe closer to $4.71, $4.72 on the adjusted number, so a slight miss there.
It's a slight miss on earnings. But revenue looked pretty solid, didn't it?
It did. Came in at $45.3 billion. That's up almost 5%, 4.9% compared to last year.
That's quite strong growth year over year.
It is, although like the EPS, it was also just, a touch below what analysts had penciled in.
Okay, so slight misses on both EPS and revenue targets.
Yeah.
But what about comparable sales? That's often a better measure of underlying health, right? Stores open at least a year.
Exactly. And there, the picture gets a bit more interesting. Total company comps were up 1.0%.
Okay, positive 1%.
But U.S. comparable sales were actually stronger, up 1.4%.
Why the difference?
Well, they mentioned foreign exchange rates acted as a bit of a drag, headwind. Took about 30 basis points off the total company number.
Right, 40 basis points, so 0.4%. Makes sense. International currency fluctuations.
Yeah. But what was really fascinating, I thought, was how the market reacted.
Oh, what happened there?
Well, despite these, slight misses on the main numbers, the stock actually jumped. It was up over 3% after they announced pre-market.
Really? After missing estimates?
Yeah. And the trading volume was high, and there was a noticeable tilt towards call options, people betting the price would go up.
Huh. So investors looked past the headline misses. What do you think they were seeing?
I think it signals that investors are maybe focusing more on the bigger picture. Home Depot's whole strategic shift towards the pro customer, the professional contractor.
Oh, the pro ecosystem strategy.
Yeah.
And the acquisitions.
Exactly. And how that's massively expanding their potential market, their TAM. It feels like the market's saying, okay, the quarter was slightly off, but we believe in the long-term transformation. It's a vote of confidence in the strategy, maybe more than the specific quarterly numbers.
That is an interesting read. Okay, so let's dive deeper then. What actually drove the performance in the quarter? Management said it was, in line with expectations.
Yeah, in line with expectations. And get this, they said it represented the strongest performance across the business in over 2 years.
Wow. Strongest in 2 years, even with the misses. So what's fueling that?
It seems to be this steady drumbeat of smaller home improvement projects. People are still doing those.
Okay. Repair, maintenance, smaller upgrades.
Exactly. And we saw that reflected in the average ticket size. It was up 1.4%.
So people are spending more each time they shop. Is that inflation, or are they buying bigger things?
It's likely a mix. Some higher value items being bought, maybe upgrading fixtures instead of just replacing bulbs, and definitely some commodity inflation still playing a role, lumber, copper, things like that.
Got it. But didn't transactions actually dip slightly?
They did, yeah. Down just 0.4%. Management said that was mostly because they pulled back a bit on some smaller ticket promotions, particularly in outdoor garden stuff.
So fewer trips, but slightly bigger spends per trip. Interesting balance.
But here's a key point for that pro strategy we mentioned. Big ticket sales, we're talking transactions over $1,000. Those were up 2.6%. Pretty robust growth there.
Okay, that is significant. Suggests maybe bigger projects aren't completely dead, or at least pros are spending.
Right. And online sales were really strong, too. Digital comps up around 12%.
12% online growth. That's huge.
Yeah, it shows those investments are paying off. And interestingly, both the pro customer segment and the DIY, the do-it-yourself folks, both posted positive comparable sales. And they were pretty much in line with each other.
So strength across both core customer groups, that sounds healthy?
It definitely is. But, strategically, the focus, the big push is absolutely towards the pro.
Right. And did they give any color on how the quarter progressed? Like, did things get better towards the end?
They did. July, apparently, saw a really significant pickup. Total company comps were positive 3.1% in July.
Whoa, from 1% for the whole quarter to over 3% in July.
Yeah, and U.S. comms hit positive 3.3% in July. They said some of that was maybe favorable weather finally hitting up north, letting people tackle outdoor projects.
Okay, weather helps.
But they also just said broader customer engagement picked up. And another sign of health. 12 out of their 16 main merchandising departments had positive comps.
12 out of 16. That's really broad-based strength. It's not just one hot category carrying the load.
Exactly. It shows resilience across the board, which, kind of gives them the foundation to make these big strategic moves, like building out that pro ecosystem.
Okay, let's really get into that pro ecosystem now.
Yeah.
It's clearly central to their story. What does that actually mean in practice? How are they building it?
So think of the pro ecosystem as their strategy to become the go-to supplier for professional contractors, builders, remodelers, for everything they need on a complex job site, not just the stuff you find in a typical retail store.
More than just a hardware store trip.
Way more. And the big move, obviously, was buying SRS Distribution last year. That was the $18.25 billion deal.
Right, SRS. They do roofing, landscaping supplies.
Exactly. And Home Depot highlighted on the call that SRS is already exceeding their initial expectations. It's speeding up their own internal efforts, creating revenue synergies, meaning the combined entity is stronger than the two parts separately, and it massively boosted their total addressable market, their TAM.
That's the $1 trillion figure, right?
That's the one. They now see their potential market as roughly $1 trillion. Buying SRS was a huge step towards capturing more of that. It's not just an add-on, it's changing the shape of the company.
And they're not stopping there. They're also trying to buy GMS, right? General Morrison Supply.
GMS, yeah.
Yeah.
Gypsum Management and Supply. That deal is pending, about $5.5 billion enterprise value.
Okay, $5.5 billion. How does GMS fit with SRS and the pro strategy?
It's a really smart fit, actually. GMS specializes in things like drywall, ceilings, steel framing, materials that SRS doesn't focus on as much.
So complementary product lines, filling in the gaps for the pro.
Precisely. It broadens the SRS distribution footprint across the U.S. and Canada and adds these critical categories. It's another piece of that single supplier for the job site puzzle.
Makes sense. And what's the status of that deal? I thought I saw something about regulatory filings recently.
Yeah, there was a withdrawal and refiling of the HSR notification. That's just part of the standard antitrust review process.
Right.
And they extended the tender offer deadline.
So procedural stuff, not a major roadblock.
Seems like it. They still expect the deal to close by the end of their fiscal year 2025, which means by January 31st, 2026. So it looks like it's moving forward.
Okay, so that's the external build-out through huge acquisitions. What are they doing inside Home Depot stores and systems to support this pro push?
Great question. They're doing a lot internally, too. One big thing is rolling out in-store trade credit for pros.
Trade credit. So pros can buy now, pay later.
Basically, yeah. Helps them manage their project cash flow. And they said it's already showing a double-digit lift in spending from the pros who are signed up.
Double-digit lift. That's significant. Shows it's meeting a real need.
Definitely. They're also upgrading their order management systems behind the scenes, adding features like inventory reservations.
So a pro can lock in the materials for a big job.
Exactly. And allowing order changes before fulfillment, plus things like invoicing upon delivery. These might sound like small tweaks, but for a busy pro, they save a lot of hassle.
Yeah, those are operational improvements that really matter to a professional customer. Less friction.
Totally. And they're tying it all together with the distribution network, the combination of the existing Home Depot stores, plus now over 1,200 SRS and eventually GMS locations.
How are they managing deliveries across all those different types of locations?
They're using machine learning. They have these ship from best location models.
Smart logistics.
Yeah, the system figures out the fastest, most efficient way to get the materials to the job site, whether it's from a big SRS warehouse, a local GMS branch, or the nearest Home Depot store. It's about optimizing the delivery using data.
Turning themselves into a logistics powerhouse for the pro, not just a retailer.
That's the goal. A seamless, high-service platform.
Which brings us to technology more broadly. You mentioned the 12% digital sales growth. What's driving that specifically?
Well, they called out investments in AI for their website search, making it smarter, easier for you to find what you need quickly.
Better search results, less frustration.
Exactly. And also features like buy it again, making repeat purchases super simple. If you always use the same type of paint or screws, you can just click and reorder.
Convenience factors.
Big time. And on delivery speed, they said they've hit their fastest ever speeds for the most products, both for same day and next day delivery.
Fastest ever. And is that translating to sales?
Apparently so. They reported a double-digit lift in spending from customers who use those faster delivery options. People value speed, clearly.
Clear return on investment there. Any other operational tech?
Yeah, they mentioned an app for their store associates, the OFA, or Order Fulfillment Associate app. It helps prioritize online orders for pickup in-store and lets associates do batch picking.
Batch picking.
Grabbing items for multiple different orders all at once instead of one order at a time makes fulfilling those online orders much more efficient inside the store.
Smart workflow improvement.
And one last point on operations. They've been diversifying where they source products from, building more flexibility into the supply chain.
Which is probably pretty important given all the talk about tariffs and global trade issues.
Absolutely. It gives them more options if one region becomes difficult or expensive.
Okay, so strong operational focus, major pro strategy build out. What does this mean for their outlook for the rest of fiscal 2025? What guidance did they give?
Well, the headline is they reaffirmed their full year guidance. It didn't raise it, didn't lower it.
Holding steady. What are the key numbers there?
They expect total sales growth for the year to be around 2.8%. And comparable sales growth roughly 1.0%.
Yeah. Okay, modest growth expectations. What about margins and earnings?
Gross margin projected around 33.4%, operating margin around 13.0%, but that's adjusted up to 13.4%.
And the bottom line, earnings per share.
That's where there's a slight dip expected. Diluted EPS is projected to decline by about 3% year over year. The adjusted EPS number is expected to decline by about 2%.
A decline in EPS even with positive sales growth. Why is that? Higher costs, investments.
It likely reflects the costs associated with the investments they're making, potentially some margin pressure, and maybe just a degree of conservatism. They are also planning capital expenditures around 2.5% of sales and opening about 13 new stores.
Right. Now, is there anything important not included in that guidance?
Yes, and this is crucial. The guidance does not factor in any impact from the GMS acquisition closing.
So potential upside there if it closes smoothly.
Exactly. It also doesn't account for big swings in foreign exchange rates or interest rate changes or, and this is key, any significant recovery in demand for those big remodeling projects we talked about.
So the guidance assumes the current environment, more or less. No big macro improvement baked in.
Pretty much. It seems like a conservative base case. They also mentioned potential price increases due to tariffs, but stressed they'd be modest and selective, not across the board. Managing costs carefully.
Okay, let's put this in the broader context for investors. Management acknowledged the housing market is still kind of sluggish, right? High interest rates keeping turnover low.
Yeah, they were upfront about that. Higher rates mean fewer people moving, which usually means fewer big renovation projects get triggered. And general economic uncertainty is making some customers postpone, though importantly, they said defer, not cancel, those larger discretionary spends.
Defer, not cancel. That's an optimistic note.
It is, and they explicitly mention potential rate cuts from the Federal Reserve, plus maybe more clarity on tax policy as things that could act as positive catalysts.
Things that could get the housing market moving again and boost consumer spending.
That's the hope. Whether it's wishful thinking or a realistic possibility, we'll see. But they clearly see potential tailwinds out there.
And how does this all tie into their philosophy about spending money, their capital allocation? They're making these huge bets on SRS and GMS.
Right. They view these big swings, building the pro ecosystem, the acquisitions, investing in e-commerce as actually being capital light, higher return opportunities compared to just endlessly building more new stores.
Capital light.
Yeah.
An $18 billion acquisition.
Well, relative to the potential return and market share capture in that trillion-dollar pro market, yes. The idea is that integrating these platforms and leveraging the network yields more profit growth per dollar invested than simply adding more identical retail boxes.
So focus on market share and earnings growth within this huge expanded market, even if it temporarily hits some metrics, like return on invested capital.
Exactly. ROIC did dip down to 27.2% from almost 32% last year. But that's often expected during periods of heavy strategic investment. They're sacrificing some short-term ROIC efficiency to build what they hope will be a much larger, more dominant, high-service platform for the pro long-term, while still keeping the DIY side strong.
It's a long game they're playing, betting big on transforming the business for that pro customer.
Absolutely.
Okay, given all that, the strategy, the market reaction, the outlook, let's step into our non-financial advice segment. Time for an outrageous but plausible trade idea based on this deep dive. What have you got?
All right. Look, the market clearly likes this pro strategy, right? The stock moved up despite the slight misses. They're aggressively building this ecosystem with SRS and GMS. So here's the thought.
Yeah.
What about a long-dated, out-of-the-money call option on Home Depot? Betting on the price going significantly higher than it is now, but giving yourself plenty of time for the story to play out.
Okay, a long call option.
Yeah.
What's the specific thesis behind that bet? What needs to happen?
It really leans on two main potential catalysts we've discussed. First, they successfully integrate GMS into SRS, creating this truly unmatched network for job site delivery and specialty products. Management sounds super confident about the synergies there.
Catalyst 1, flawless integration and synergy realization.
Right. Catalyst 2, the macro environment actually improves. Imagine the Fed does cut rates, even just modestly like management hopes.
Okay, rate cuts happen.
That could be the key to unfreezing the housing market and unlocking all that deferred demand for large discretionary projects that customers have been putting off.
So you get a double boost.
Exactly. You get the operational power and the bigger market share from the pro strategy, plus a surge in high-ticket demand driven by a better macro climate.
Huh?
It's a bet on their execution meeting a more favorable environment.
The pro strategy paying off just as the market for big projects thaws out could lead to a pretty significant stock move if both things click.
Potentially, yeah. It's definitely playing the long game on the pro focus and a macro recovery. Outrageous, but plausible, perhaps.
Definitely food for thought. Okay, let's wrap up our deep dive on Home Depot's Q2 FY 2025 earnings.
Yeah, the key themes seem pretty clear. Performance was solid, actually the strongest in a couple of years by their measure, driven by those smaller projects and a really strong digital growth.
And strategically, it's all about the aggressive expansion of that pro ecosystem. Big acquisitions like SRS and GMS, plus internal tech and operational investments to support it.
Right. And they held their full year guidance steady, showing confidence, but it's a guidance that doesn't bake in a lot of potential upside from the pro integration or a macro recovery.
They're positioning hard for long-term share gains in that massive trillion-dollar market.
So here's something to think about as we finish. As Home Depot keeps making these big swings to consolidate the pro market, integrating AI and machine learning for efficiency, how could this fundamentally change the whole home improvement industry?
What does it look like if one company truly becomes the dominant single supplier for complex pro jobs? Could Home Depot actually achieve that? And what would the ripple effects be for competitors, suppliers, and even the pros themselves?
Lots to consider there.
Indeed. And remember, everything we've discussed today is purely for informational purposes. It is absolutely not financial advice. We always encourage you to do your own research, ask your own questions, and reach your own conclusions.
Thanks for joining us on the Deep Dive.